everyone, welcome back. Ready for another deep dive? Today we're tackling this Motley Fool article, 3 soaring stocks I'd buy now with no hesitation. And the title alone, it definitely caught my eye.
Yeah, it's bold.
It is, but that's kind of their style over at the Motley Fool, right?
Oh, yeah, definitely. They like to make a statement.
Yeah, they do. And it makes sense why these stocks kick your attention. We're talking about companies that have already seen some impressive gains, but the article argues there's even more room for them to grow.
Right. So the question is, what's fueling that potential? What's got them so optimistic?
Exactly. And that's what we're going to dig into today.
All right, let's do it.
All right, so we've got 3 companies on the list. First up, we've got Carnival Cruise Line. They're kind of like the comeback kid of the stock market this year.
Yeah.
Their stock is up over 20% since January.
Yeah, it's a pretty dramatic turnaround, especially considering how hard the cruise industry was hit during the pandemic.
Oh, yeah, for sure. I mean, remember back then, it was all about canceled voyages and ships stuck at sea, and the whole industry was dealing with massive debt.
Absolutely. And let's not forget the negative headlines, the uncertainty around travel restrictions, and how that really impacted consumer confidence.
Yeah, it was a rough time. But, looks like Carnival's managed to weather the storm,
Yeah, they've implemented some pretty impressive strategies to get back on course.
So what did they do? How did they pull off this turnaround?
Well, for starters, they got serious about cost cutting. They streamlined operations, renegotiated contracts, and made some tough decisions to reduce expenses.
Right. Makes sense. Got to tighten the belt when times are tough.
Exactly. But they didn't just stop at cutting costs. They also focused on increasing onboard spending. They introduced new experiences, like upgraded dining options, those kind of things.
Oh, like those specialty restaurants and the fancy cocktail bars they have on those ships?
Yeah, exactly. Things that entice passengers to spend a little extra. And it seems to be working,
Yeah. The article actually highlighted that Carnival hit record revenue and operating income in their latest quarter.
That's right. And their advanced bookings are also looking strong, with passengers willing to pay higher prices, which is a positive sign for their future revenue.
Wow. Okay, so people are clearly eager to get back to cruising. I mean, it makes sense. After being cooped up for so long, who wouldn't want to escape to, a tropical island?
Exactly. It's that pent-up demand, the desire for travel experiences, and, a bit of escapism that's driving this resurgence in the cruise industry.
Okay, so let's talk numbers for a sec. Carnival's currently trading at about 20 times their trailing earnings. But before the pandemic, they were trading at above 40 times earnings. So does that mean, does that suggest there's still room for their stock to climb higher?
It's certainly a possibility. The current valuation suggests that Carnival might be undervalued compared to its historical performance.
Interesting. Okay, so Carnival's looking pretty good. Now let's move on to our next company, Amazon.
All right, now everyone knows Amazon, right? The online retail giant.
Yeah, I mean, who hasn't ordered something from Amazon?
Probably not many people. But what's interesting is that the article focuses on 2 specific growth areas for Amazon. E-commerce, obviously, and their cloud computing platform, Amazon Web Services, or AWS.
Right, so they're not just an online store anymore.
Exactly. They've diversified their business model, and AWS has become a significant revenue generator for them.
Okay, so we've got e-commerce and cloud computing, but where does AI fit into all of this?
Well, that's where things get even more interesting. Amazon is actually using AI across both of these areas to enhance their operations and create new opportunities.
Oh, okay. So how are they actually using AI? Give me an example.
Sure. So on the e-commerce side, they're using AI to personalize shopping experiences, optimize logistics, and streamline their supply chain.
Makes sense. The more efficient they can be, the more money they can make.
Precisely. And with AWS, they're providing tools and platforms for other companies to develop and deploy their own AI applications. So they're not just using AI for their own benefit. They're enabling others to leverage its power as well.
Wow. So they're on both sides of the AI boom as a provider and a user. That's pretty smart.
Absolutely. And it's a strategy that positions them well for continued growth in a rapidly evolving technological landscape.
Okay, so the article mentioned that AWS is on track to hit a $110 billion annual revenue run rate. I mean, that's a massive number.
It is. And it speaks to the scale and reach of Amazon's cloud computing business.
Okay, so given that, impressive growth, how do you view their current stock valuation? I mean, they're trading at about 38 times their forward earnings.
Well, Amazon has consistently demonstrated its ability to generate substantial revenue and earnings growth. So while a price-to-earnings ratio of 38 might seem high compared to some companies, it reflects the market's confidence in their future prospects.
Right, so it's like investors are willing to pay a premium for a company that they believe has strong growth potential.
Exactly. And with their continued investments in AI and cloud computing, Amazon is well positioned to maintain that growth trajectory.
All right, so we've covered Carnival, we've talked about Amazon. Now let's move on to our final company, Costco.
Right, Costco. The land of bulk buying and those giant pizzas, right?
Oh, yeah, for sure. But here's a little fact about Costco that might surprise you. The bulk of their profits actually come from membership fees, not from the products they sell.
Yeah, that's one of the things that makes Costco's business model so unique and successful.
It's like their secret weapon.
Exactly. Those membership fees provide a steady stream of revenue that allows them to keep their prices low and attract a loyal customer base.
So explain that a little bit more. Like, how does that actually work?
Sure. So basically, Costco charges an annual membership fee for the privilege of shopping at their warehouses. And because they have such a large membership base, those fees add up to a significant amount of revenue.
Okay, but how does that allow them to keep their prices so low?
Well, because they're making so much money from membership fees, they don't have to rely as heavily on profit margins from individual product sales.
I see. So it's like they're using the membership fees to subsidize the low prices.
Exactly. And those low prices, combined with the wide selection of products and the whole treasure hunt experience of shopping at Costco, are what keep customers coming back year after year.
And those customers are definitely loyal. Their membership renewal rates are consistently over 90%, which is incredibly impressive.
It is. People love their Costco memberships. And that loyalty is a testament to the value that Costco provides.
Okay, so, we're seeing this trend of high margin membership fees with companies like Costco and, even Amazon Prime, right?
Yeah.
It seems like a winning strategy.
Yeah, it's becoming increasingly popular, especially for businesses that can offer a unique value proposition and cultivate a strong sense of community among their members.
Right. So Costco's currently trading at 49 times their forward earnings. That's a pretty premium valuation.
It is, but it reflects the strength of their business model, their consistent performance, and the market's confidence in their continued growth.
Okay, so we've got three very different companies here, each with their own unique story.
Yeah.
Carnival, bouncing back from the pandemic.
Right.
Amazon, leveraging AI to dominate in e-commerce and cloud computing.
And Costco, with their unique membership model.
Yeah. It's interesting how they've all tapped into what consumers value, whether it's experiences, convenience, or just like a good deal.
Exactly. And I think that's one of the key takeaways from this article. It's not just about looking at the numbers, it's about understanding the underlying story, the value proposition that each company offers, and how that resonates with their target market.
Right, because ultimately that's what drives success in the long run.
Absolutely.
Okay, so we've talked about these companies, their strengths, and a little bit about what makes them potentially good investments. But now I want to get your take on this. Which of these companies piques your interest the most? And, if you were considering investing, what factors would you consider before making that decision?
That's a great question. Let's see. Well, if I were looking at these three, I think for me, Amazon would be the most intriguing. Their dominance in e-commerce and cloud computing is it's undeniable.
Yeah, they're like a tech powerhouse.
Exactly.
Yeah.
And with their aggressive push into AI, it feels like they're really shaping the future of, well, not just online shopping, but technology in general.
Okay, so Amazon for you. But what about risks? Every investment has risks, right?
Oh, absolutely. And I think with Amazon, one of the biggest risks is competition. They're not the only player in e-commerce or cloud computing.
Right. Like Walmart's making a big push online, and then there's, what is it, Microsoft Azure and Google Cloud for cloud services.
Yeah, exactly. So while Amazon's a leader in those spaces, they can't afford to get complacent. They need to keep innovating, keep pushing the boundaries to stay ahead of the curve.
Okay, so competition is a risk. What about their financials? A lot of these tech companies are investing heavily in AI, which can be expensive.
Right. And those investments might not pay off immediately. So I definitely want to take a closer look at their financials, see how those AI investments are impacting their profitability.
Yeah, that makes sense. What about Carnival? They seem to be making a strong comeback, but are there any red flags there that would make you hesitate?
Well, one thing that would give me pause is the cyclical nature of the travel industry. It's susceptible to economic downturns, People tend to cut back on travel when money's tight.
True. And I mean, we just went through a pandemic. Who knows what the future holds, right? Like another global event could really disrupt the travel industry again.
Exactly. So, while Carnival's doing well now, it's important to consider those external factors that could impact their future performance.
Okay, and what about Costco? Seem pretty solid with their membership model, but are there any risks there that we haven't considered yet?
Well, one potential challenge for Costco is inflation. I mean, their whole model is based on low prices, right?
Right.
So
Yeah.
if they have to raise prices significantly due to inflation,
Yeah.
it could impact their customer loyalty.
Yeah, that makes sense. People might start shopping around more if those deals aren't as good anymore.
Exactly. And then there's the whole question of, well, e-commerce, right? I mean, Amazon and other online retailers are putting pressure on traditional brick-and-mortar stores like Costco.
Right. So they need to make sure their in-store experience is still appealing enough to keep people coming back.
Exactly. They've got to offer something that you can't get online, like that treasure hunt vibe, the unique product selection, and maybe even enhance their online presence, too.
Okay, so we've kind of flipped the script here, talking about the risks instead of just potential rewards. I think that's really important, to look at both sides of the coin.
Oh, absolutely. It's easy to get caught up in the hype, especially when an article is titled, stocks I'd buy now with no hesitation. But a smart investor, well, they always consider the potential downsides as well.
Right. And even though this Motley Fool article is, generally positive about these stocks, they do acknowledge some of the risks, too. They don't shy away from that.
Yeah, and that's what I appreciate about them. They're not just trying to sell you something. They're presenting information, both the good and the bad, to help you make an informed decision.
Exactly. So let's say someone's listening to this and they're really intrigued by one of these companies. What would be your advice to them? Like, what should they do next?
Well, first, I'd say don't jump in head first based on just one article, even if it's from a reputable source like the Motley Fool. Do your own research, dig deeper.
Yeah, do that due diligence.
Right. Look beyond the headlines, check out the company's financials, read analyst reports, and even look at what their competitors are doing.
I like that. Get the full picture before you make a decision.
Exactly. And don't be afraid to ask questions either. If something's not clear, reach out to a financial advisor or someone you trust who has experience in investing.
Okay, so we've talked about the potential rewards, the potential risks, and the importance of doing your research. But what if someone's like brand new to investing? They're hearing all this talk about stocks and earnings and valuations, and it just seems overwhelming.
Yeah, I can definitely see how it can be intimidating. But I think the most important thing for new investors is to start with the basics. Educate yourself. There are so many resources available online, books, courses, even podcasts like this one.
Yeah, for sure. You don't have to become an expert overnight. Just take it step by step.
Exactly. And remember, investing is a journey, not a sprint. It's about learning, making informed decisions, and building your portfolio over time.
All right, so we've covered a lot of ground today, talking about these soaring stocks, the factors driving their growth, and the importance of being an informed investor. But before we wrap things up, I want to leave our listeners with a final thought-provoking question to ponder.
Oh, I like this. What is it?
So we've touched on how AI is changing the game for companies like Amazon, but looking ahead, what role do you think AI will play in the future of investing, not just for companies, but for individual investors like you and me?
Wow, that's a big question to consider.
It is, but I think it's an important one, especially as AI becomes more and more prevalent in our lives.
Right, absolutely.
Yeah.
I mean, we're already seeing AI being used in like robo-advisors and algorithmic trading.
Yeah. And those are just the early stages. Imagine a future where AI can analyze massive amounts of data to identify investment opportunities that humans might miss.
Yeah, or like personalized investment strategies based on your individual goals and risk tolerance. It's like AI could be your own personal financial advisor, constantly monitoring the market and making adjustments to your portfolio.
Right. And maybe it could even help us avoid those emotional decisions that we sometimes make as investors, like selling out of fear when the market dips or chasing those hot stocks that everyone's talking about.
Yeah, that's a good point. AI could potentially bring more objectivity and discipline to our investing decisions.
Okay, but let's flip the script for a second. What about the potential downsides of AI in investing? Are there any risks that we should be aware of?
Well, one concern is the potential for bias. I mean, AI algorithms are only as good as the data they're trained on, right?
Yeah.
So if that data is biased in some way, it could lead to unfair or discriminatory investment decisions.
That's a good point. And what about like the complexity of these AI systems? I mean, if we don't understand how they work, how can we trust them to manage our money?
Yeah, that's a valid concern. Transparency and explainability are going to be crucial as AI plays a bigger role in finance. We need to be able to understand the logic behind those AI-driven decisions, not just blindly trust the algorithms.
Right. And then there's the whole question of like job displacement. I mean, if AI can do so much of the work that human financial advisors currently do, what does that mean for the future of those jobs?
Yeah, that's a big one. It's likely that AI will automate certain tasks, which could lead to some job displacement. But I also think it'll create new opportunities, like roles focused on developing and managing those AI systems.
Right. So it's not necessarily about AI replacing humans, but rather like humans and AI working together, right?
Right.
Each leveraging their own strengths.
Exactly. It's about finding that balance, that synergy, where AI can augment human capabilities and help us make better decisions.
Okay, so we've talked about the potential benefits, the potential risks, and the big questions surrounding AI and investing. It's clear that this is a technology that's going to continue to shape the financial landscape.
Oh, absolutely. And it's going to be fascinating to see how it all unfolds in the coming years.
Well, on that note, I think it's time to wrap up this deep dive. We've covered a lot of ground today. We talked about those soaring stocks, the importance of due diligence, and even took a glimpse into the future of investing with AI.
Yeah, it's been a great discussion, really thought-provoking.
I agree, and hopefully it's given our listeners a lot to think about. So, as always, remember that knowledge is power, especially when it comes to investing. Do your research, stay informed, and keep diving deep.
Couldn't have said it better myself.
And until next time, happy investing.